Welcome everyone to EV Summit Online Series for World EV Day. Today, the panel is Investing in US eMobility. Earlier today, we heard from a bunch of panelists today talking about cities and eMobility and the challenges and the benefits that it faces. So today, we're going to be talking about investment. And, for me, it's just wonderful to be here for World EV Day. And one of the things I'd really want to highlight before we start here is that one of the greatest personal impacts or impacts as a business that we can have is to be able to reduce our carbon footprint by going EV. Our personal family situation, we reduced our carbon footprint by 90% by going EV. And we know that people out there and businesses can do the same. The wonderful thing that we have is that people right around the world are attending today. And it's just so good to have literally hundreds of people on this call today, and that is just amazing. With that in mind, we're going to hear from 5 expert panelists who are experts in investment and have had experience in EVs and investments, both from a OEM point of view and from a infrastructure point of view. So we're going to hear about both today. So let me introduce these panelists. So firstly, we have Ahmad Thomas, who's CEO of Silicon Valley Leadership Group. And now he's got deep experience in this area, and we're really looking forward to hearing from him. The second is Arkady Sosinov, who is the CEO of FreeWire Technologies. We also have Catherine Kargas on the phone, who is the Vice President of Marcon, consulting company up here in Canada. We also have Michael Lingenfanger, who's the VP of Wells Fargo Technology and Venture Banking Group. Great to have Michael on and his experience today. The last person we have is Roby Mitra, who's the Finance Director of Bollinger Motors. Welcome to you. Thank you so much for all your time today, and we really appreciate you being part of this panel for World EV Day today. So firstly, I'd really like to introduce Ahmad here. Ahmad is the CEO of Silicon Valley Leadership Group and brings 17 years of experience working both in and on behalf of nonprofits for governments and businesses. As the SVLG, he leads in urgent action to address racial injustice, equity, and opportunities with its 350 plus member companies in efforts that strengthen Silicon Valley's competitiveness and economic strength and innovation. Welcome, Ahmad. It's great to have you here today.
Yeah, thank you very much, James, and good morning from California. I'm so excited to be here today speaking about a topic that is very, very topical. Here in California, our state has been ravaged by fires. It is the morning time, but it is dark, amber-colored skies due to the fires. It was 100 degrees Fahrenheit in San Francisco over the weekend. So clearly something is not right. And as we talk about climate change, as we talk about the need to spur zero-emission vehicles, EVs, the importance it has to our climate, to our environment, it just could not be more topical. And thank you also to Green TV for its leadership and dedication to our climate goals during these extremely challenging times. Now, I'm just going to speak for 5 minutes or so, a couple items to talk about as we lead up to our panel. I'll focus on the scale of the issues we face in driving, pun intended, e-mobility investments. And then I'll very briefly speak to the path forward and further frame concerns for our panel as we orient the discussion, as James noted, around investment-driven solutions. Now, today's panel focuses on what I believe is one of the smartest long-term investments that we can make, which is e-mobility. And if I turn to the scale of the issues we confront, I'll talk about California, and I'll first start with our transportation sector. In California, the transportation sector accounts for more than 40% of statewide emissions. So in order to decarbonize transportation, we must deploy zero-emission vehicles throughout our state. Everyone on this line knows, I know James and our panelists understand very well, that if we take our state, zero-emission vehicles are critical to public health, to air quality, and to meeting our emission reduction goals. However, in order to reach our goals, 40% below 1990 levels by 2030, We need to increase our annual reduction rate from 1.1% to 4.5%. If we don't, we will not reach our climate goals until 2061. In California, we've got 720,000 plus EVs on the road and more than 27,000 public charging stations today. But this is a far cry from the 5 million goal for zero emission vehicles by 2030. And in order to get there, we must increase our numbers an average of 23% annually starting now. On the EV infrastructure side, which is where I have the most familiarity, California will need to install charging points at about 20 times the current rate, completing 18 sites per day for the next 5 years in order to meet our 2025 goal of 250,000. This is critical because we know that the lack of charging infrastructure is considered a significant barrier to the wide acceptance of electric vehicles. So where's the money for EV infrastructure coming from? If we look at California, currently our state has enough funding for 160,000 charging stations, but needs funding for 90,000 more to reach the 250,000 goal. The California Public Utilities Commission has already approved $700 million for utilities to invest in EV infrastructure through 2024. And $436 million has come from Southern California Edison's EV infrastructure program, of which 50% is located in underserved communities. There are also numerous state programs providing financial support for charging infrastructure, including the Energy Commission's $384 million program. And recently, the leadership group, one of our member companies, ChargePoint, announced that it closed $127 million in incremental equity financing. It's all very exciting, but it's just not enough. We must develop financing solutions and structures to support large-scale EV charging infrastructure. And I would close with a couple points on the path forward as we open this up to our panel. At the leadership group, as James noted, we have membership of roughly 350 of the largest employers here in Silicon Valley. Our EV member companies include Proterra, Tesla, General Motors, BYD, ChargePoint, NLX, and Volta Charging. We are trying to lead the electrification of public, private, and commercial vehicles. And it's also about competitiveness. And as we look to recover from COVID-19, as we talk about environmental equity and racial justice, environmental equity in our underserved communities, we support pursuing a recovery that meets a triple bottom line, which is creating genuine, equal economic stimulus, meeting community resiliency needs, and finally targeting clean investments to support underserved communities hardest hit by climate change and by COVID-19. This is the environmental equity that I spoke to earlier. So I'll just finish by saying that the clock is ticking and we must move faster. In spite of our technological leadership, we have a long way to go on financing and implementation to meet our 2030 goals, but we've got an esteemed panel here today that I know has a lot of great thinking and solutionating going on to share with all of you. So I'll leave it there to open it up to our panelists and James and to everyone here. Thank you very much again for having me and so many of our Silicon Valley Leadership Group member companies today.
Thank you very much, Ahmad. It's really great to see you here today. And I know you've just joined Silicon Valley Leadership Group, and you know that really sets the direction for the rest of this panel. And we really appreciate this overview. So right now I have a question for you as part of our panel here today. I know you have a lot of experience in the public-private partnerships investments. What are the key factors that you see as the most important to success for these partnerships when sustainably building out EV infrastructure?
Yeah, it's a great question, James, and I think it follows on the introduction I gave that really speaks to the the challenges we face in meeting the gap for financing EV infrastructure on a large scale. And there are probably 2 or 3 issues that I believe are pretty paramount in addressing to be able to solve this problem. And I worked on this as an investment banker at Barclays. We had some pretty innovative programs with some of our member companies to try and spur EV charging station investment in particular. And we were not really able to see the deals close and get to a point where we needed to be. So I wish I had great solutions for you, but I do not. I do know what some of the impediments are. One is that the useful life of the asset has got to usually match the term of financing. Others on the panel will be able to speak to this in more detail than I, but technology is evolving every day. If you're looking at a 5 or 7 year financing for matching the useful life of an asset, it's very difficult to fund at a scale that you need in a manner that is affordable to your borrower. There's a lot of free money out there. So in my case, we were dealing with public sector entities, trying to get large scale EV charging infrastructure funded for, say, a city or a county. Why should they finance that when they can get the money for free from some of the programs or the state that I mentioned earlier? But the problem with that is going pay as you go on an incremental basis does not get us where we need to be now or in the very near future. And I think maybe the last point here is when you look at the revenue stream and how you actually pay back the debt with which you would finance this infrastructure. If you took it on the general fund of, say, a municipality, if it was for their own EV fleet, that might make sense. Or if you were able to backstop that debt with grant money, that might make sense if you had a high degree of probability the grant could be funded. But it's just not possible to charge enough for charging from consumers to be able to pay the debt service associated with financing that type of infrastructure. So I'm sorry I don't have easy answers here, but I hope that at least begins to set the table for the rest of our esteemed panel.
No worries. Thanks, Ahmad. You know, I think just to let everyone know, please submit your questions for Ahmad through the Q&A panel. If you go to the bottom of your screen there, you'll see the Q&A box. Please hit that, send Ahmad or any of the other panelists a question, and we'll make sure to try and get them and ask them. But we do, Ahmad, we do have a question for you right now. This is from A. Thomas. Does the global infrastructure community understand a huge significance needed for decarbonization of the entire transportation sector? And will it, therefore, pull the financial levers at scale needed to deliver the total transformation?
Yeah, that's a great question. And I would speak to that looking at maybe one segment of the institutional investor community, right? And I would speak specifically to ESG investors, environmental social governance investors. When we talk about climate change, when we talk about social impact, this is a burgeoning sector that we've seen with large institutions that is growing at a rapid scale. I saw a number last week that had a $20 trillion number for the potential ESG market today. And what I found working on social impact financings was that there was more capital in need of placement than projects to be financed. So speaking to this question very specifically, looking at infrastructure and EV charging infrastructure, I have no doubt that within the large institutions, within impact funds, within ESG funds, there is enough capital there. I think the question is finding a financing structure, a scale that works for these larger investors. A $5 million deal doesn't cut it. You need scale at 350 million, larger numbers to be able to entice the Eaton Vance, the Fidelity, the Vanguards, the Goldman Sachs, the JP Morgans, et cetera. But I know that within their goals, when we talk about climate change, when we talk about impact infrastructure, EV charging infrastructure certainly meets that investing criteria.
Yeah, very cool. Thank you. We have another question here. How have you seen the e-mobility investment trends change in the last 5 years?
Yeah, that's a great question. And I would say at least from what we see, looking at some of our member companies, I would take ChargePoint as one example where we've seen a tremendous amount of success. Proterra is another example where Ryan Popple recently has left to a chairman executive director role there, who sits on the board to which I report. But they have been very, very competitive and I think very successful in being able to raise more funds. We mentioned the series that just closed for ChargePoint. So I answer that very simply by saying that I believe that there is more capital and more willingness, more demand to invest in some of our innovative companies. Now, where I don't know the answer, or I might be interested in what other panelists might have to say, is what that means for the burgeoning or more startup companies within this space. We know for GM projects, we know for ChargePoint, we know for Proterra, the money is there because they have an established product and they've been able to show leadership within the sector. I don't know the answer when we speak to the growth beyond the well-established firms within this space. But I do know if we look back over the last 5 years and how the companies who have done well and who have been able to separate themselves have fared, the outlook previously and going forward has been very, very strong. And, you know, you look at the leadership of, if we pick up Proterra as one choice, I've got to know Ryan a little bit serving on the board. I would be extremely bullish because I think that there's a recognition, as I rattled off some of the numbers looking at California, the steps we need to take to meet our emission reduction goals. I think there's a very clear recognition that the private sector is going to drive these solutions. And maybe that recognition is more clear today than it was 5 to 10 years ago.
Yeah, no, very cool. Thank you, Ahmad. Another question here from Ash Vinsuri. In your view, what level of IRR returns can investments in EV charging infrastructure deliver to investors?
Yeah, that's a good question, because if we look at it, I'll speak to specifically what I know, which are the deals that we try to structure related to municipalities. So these are public sector transactions that we did not bring a deal to market or close, but that we look to try and finance for, say, a fleet of EVs. And if you're looking at IRR, you're just looking at return period, it's very low, right? A municipality that's in California at double or triple A for some of these, if you take San Mateo County, for example, where I live, which is where many of the VCs are based, they have a triple A credit rating. So they are going out and borrowing, if you're taking, say, an equipment lease program, if I were to pick one, the rates are going to be in the, I don't know, maybe 3% yield, right? If you're looking at your all-in TIC, your total interest cost, it might be slightly less than that. So you've got to have a cause here that goes beyond return. I don't, for the deals that I have spoken about here on this panel, I don't see a very strong or compelling case to be made for a, say, a PE type return, right? There has to be an impact calculus that's factored in here, because the public sector deals, or a deal that might be have grant backing or grants in some way providing a double barrel backstop to the borrowing, that's further driving down the borrowing costs. So these are not in any way high yield transactions, even on an unrated basis, in my opinion.
No, thank you, Ahmad. That's really important, and thank you for going through those details. So what we're going to do now is we're going to move over to the next panelist, and thanks again to Ahmad. And our next panelist is Arkady Sosunov, who is the CEO of FreeWire Technologies. Now, Arkady is the CEO and co-founder of FreeWire. He has led the company from ideation, formation, incubation, and now oversees customer acquisition and revenue growth. Prior to FreeWire, Arkady spent 7 years in the finance industry creating financial database analytics suite for emerging markets in that trades. And in that space, there was more than $130 billion in assets. Welcome, Arkady. It's really great to have you along as a technology leader. It's terrific to have you on the panel today.
Thank you, James, and thank you, Ahmad, for that overview of the industry. I'm reporting to you live from the surface of Mars, And I know that's a cheeky comment, but for those of you in the San Francisco Bay Area that have looked outside today, I'm sure you thought the same thing. And it just strikes to serve the point that we're trying to make today, which is that electric vehicle adoption, electrification needs to happen quickly. Those of us in the industry understand that it's a mega trend, but it couldn't come soon enough. We are experiencing as a civilization what China has experienced over the last decade to 15 years. And we've seen what's happened there, which is a move towards green energy, a clean economy. And they're effectively the leader in clean energy today. So I hope that days like today in the San Francisco Bay Area really serve to move our agenda forward. So a little bit of background.
Yeah, totally. Thank you, Katie. I mean, what a day to have it. World EV Day, when everyone can really see the impact of, climate change and the visually see the picture of it's being painted in California. So I think that's, super important. So, the question we have for you today is, with your work at FreeWire, paint us a picture of how cost down and improve user experience benefits EV charging and encourages electric vehicle uptake.
Yeah, absolutely. Well, let me give you a quick background on what we do. What FreeWire does is we develop EV charging technology to enable ultra-fast charging electric vehicles, but we solve the pain point of the infrastructure behind that charger, right? So what we've done is package energy storage with charging technology and software to effectively be able to deploy ultra-fast chargers using low-power infrastructure. Now, what that does for our customers is obviously reduce the infrastructure cost behind the charger. So instead of paying several $100,000 for the infrastructure behind a charger, our customers pay low tens of thousands of dollars for the infrastructure behind a charger, which serves to increase the IRR that Ahmad was mentioning earlier. So in use cases that we've deployed our charger, which is called the Boost charger, because it effectively boosts the power at the grid edge, in those cases, we've seen IRRs as high as 40% over 5 years. That is a game changer for this industry, but more so than increasing the economic equation around charging and making charging actually feasible from a commercial standpoint, what it does is it serves to open up the addressable market for charging, because now we can deploy charging infrastructure in places that would have otherwise been disqualified. Think about it this way, that if you are a retail owner and you own 100 sites, you may have chosen the best 10 to deploy charging, or the 10 that were most commercially viable, the cheapest to deploy that charging infrastructure. You disqualify the other 90 and everyone forgot about it, right? What we are able to do is unlock the other 90 locations, making charging more readily available and accessible for EV drivers, which then promotes our mission of higher EV adoption. Now, I want to talk about a few pitfalls and a few opportunities in this industry that I've noticed. We are still making mistakes as an industry, but we do have a few opportunities that can be game changers. So a couple of mistakes that I believe we're making is things like make-ready infrastructure. There is a push towards having utilities deploy infrastructure underground and with hundreds of millions of dollars allocated towards that. I do not believe that is the right approach. And if you look at the previous quarterly results around these programs, you'll see that they're highly inefficient and the spending is highly out of line with what companies like FreeWires and ChargePoints and Voltas and EVgo's and Electrify Americas can achieve through more effective uses of their capital. I do not think make-ready infrastructure is a model that we should see across outside of California, and that's something that we are fighting against. However, there are models that are really working well. The California Energy Commission, for example, in deploying capital towards infrastructure projects, I think is working well. And the California Energy Commission is working on a new program called TERPA, T-E-R-P-A. TERPA will do for EV charging infrastructure what PERPA did for solar several decades ago, in that it incentivizes highly efficient uses of capital so that we can lower rates for all ratepayers, not increase rates for ratepayers, similar to what make-ready programs are doing. So I'm very, very bullish about that, highly supportive of the CEC's goals for making TERPA happen. I also see some opportunities in new investment players coming into the space. We have raised, over the course of 6 years, about $45 million in equity financing for FreeWire. And in the early days, that came from the usual players, oil and gas companies like BP. We had investment from ABB, who's arguably one of the leaders in fast charging today, but generally strategic investors are who invested in FreeWire. What we're seeing now is a completely different trend. We're seeing an influx of private equity and infrastructure funds into the space. And that marks a new milestone for EV charging. That means that infrastructure players, private equity players that have much lower risk profiles than some of the corporate strategics are starting to understand that IRR can be generated across large swaths of charging infrastructure. They see the gold rush that is happening in EV charging plainly, and they are coming into the space, and that's really exciting. And the entire investment thesis that I've seen happening across the space follows the journey of the electric vehicle customer and the customer that buys charging infrastructure. So in the early days when charging was still kind of an unknown, almost like a test case, that was 5-6 years ago when Google deployed charging stations across their campus, when you saw a few charging stations deployed with municipal fleets, you saw mostly corporate strategic investors invest. Now that they're being deployed in large swaths across public, retail, fleet, network operators, the private equity players are just jumping in, and they're jumping in quickly. Right. And so what I see happening over the next few years is not yet the big banks coming in, and maybe Michael can talk about that from the Wells Fargo perspective, but I see some of the more risk-seeking private equity players just really jumping into the space and putting huge swaths of capital, and I'm talking about hundreds of millions to low billions of dollars of capital in chunks into EV charging infrastructure to be deployed in locations with high utilization. What I see happening, yeah.
Thank you. Sorry, thank you. We just run out of a little bit of time there, but we do have a question, and I've actually had 2 or 3 people send it to me. Can you explain a little bit more about, you made us some comments about Make Ready. Why do you think it's not so good? What's the, you have some negative thoughts about it, or, perhaps what are the improvements that could be made?
Sure. Make Ready programs, the concept of them is that you're paying for the utility to pull power to locations, right? So the utility pays for everything up to the stub, or where the power comes out of the ground, and then you have others place charging infrastructure on top. That is not incentivizing efficient use of utility infrastructure. There are better ways to deploy charging. There are ways to deploy charging where you can have a battery integrated approach similar to the way FreeWire does, where you're actually smoothing the consumption curve, right? There are ways to provide mobile charging infrastructure. There are ways to provide solar charging similar to the way companies like EV Arc does. So there are ways to more efficiently use the existing infrastructure. This EV charging at scale will not work if we simply put copper in the ground. There is too much demand that is going to happen on utility infrastructure. You are going to need larger peaker plants behind all of that infrastructure. You're going to need to scale up everything behind it, and that is completely cost ineffective. Utilities are also not necessarily the best stewards of that capital. The utilities are incentivized to put infrastructure in the ground and make a return on it. We need to not do that, and we need to make sure that charging is available anywhere consumers want in the most cost-effective way. So I don't believe in make-ready infrastructure. I think it was great in the early days to just spur on initial investments to lower the cost, but I think there's a better way to lower costs for all ratepayers.
Thank you, Katie. Really appreciate your comments and the extra comments on Make Ready right there. Right now, we're going to switch over to Catherine Kargas. Now, Catherine has joined us late, and we are so super happy to have her on the panel. Now, Catherine is having some health treatment right now, so she'll just join us with her picture up there. However, I would really want to read out her bio. Catherine Kargas is a mobility advisor with more than 30 years of experience in consulting in the areas of electrification of transportation. She's led Electric Mobility Canada as chair for 6 years and acted as president and interim CEO. She works with multiple stakeholders in the industry, including vehicle and charging manufacturers, electric utilities, governments and network providers. And I know Catherine well, and it's really great to have you here today, Catherine.
Thank you so much, James, and thank you for having me. I think I've been listening to the first two presenters, and the information being shared is absolutely fantastic. So I'm really, really happy to join the conversation.
Thank you, Catherine. It's great to have you. So I have a question here for you. We know that heavy-duty vehicle electrification has a real pathway forward for electrifying. What are the key areas that we need to work on to ensure that appropriate infrastructure is developed, that investment comes through, and that it all falls into place as the OEMs roll out their new electric trucks?
Yeah, that's a great question. In fact, I mean, we finally entered a period where we can start to incorporate heavier electric vehicles into our mobility mix. Commercial vehicles, as was mentioned by Ahmad before, comprise a category of motor vehicles used for commercially transporting goods or passengers. So I'm stating this because I want everybody to understand what exactly we're talking about. This category includes trucks, vans, buses. In 2018 alone, we had approximately 4.2 million heavy commercial vehicles and over 20 million light commercial vehicles that were produced throughout the world. So take those millions of vehicles and understand that the opportunity is enormous. Just to ensure that we're all on the same page, in the area of mobility of people, we're essentially talking about buses, transit and school buses, okay? In the area of mobility of goods, we're talking about vehicle classes 5 to 8. So trucks of various sizes. And as we've witnessed, electric transit and school buses are commercially available and have been for several years. Multiple transit agencies have already started the transition to electrification. Multiple infrastructure paths are available depending on the routes and duty cycles. Here, agencies need to ensure that they assess the costs associated with each charging path and ensure that they are planning with tomorrow's technology in mind. That's the thing that we need to keep in mind. Agencies also need to be mindful of the costs as selecting some charging paths, as was just talked about, is significantly more expensive. This is taxpayer money, folks, and we need to invest it respectfully. Where we're seeing enormous promise is in the movement of goods. The average heavier vehicle generates multiples more GHG emissions than the average individual passenger vehicle. So the environmental savings are considerable. With Tesla and more established truck makers like Volvo, Daimler unveiling electric models, electric commercial trucking is getting increasingly more attention. But charging infrastructure for these vehicles is underdeveloped. In Europe, for example, the European Automobile Manufacturers Association released data indicating that we need approximately 90,000 public charging points over the next decade in order to be able to transition to carbon neutral road transport. And the issue is that the charging points that are there right now are not the ones that we're going to need for these larger vehicles. Now, to hit the 2030 target, Europe is going to require a fleet of 200,000 electric trucks. Just in terms of context, to let you know where we're at, there were about 700 medium duty and heavy duty trucks sold in Europe in 2019. So we're talking about many, many more that are going to come over the next few years. In terms of charging needs, Europe is going to need 90,000 charging plugs by 2030, like I mentioned, and 37,000 of them have to be installed over the next 5 years. And the situation is no different in North America, right? Commercial trucks can't use the same charging infrastructure as passenger cars. They're going to need bigger battery packs, they're requiring higher power stations and drawing more energy. Stations will also need to be designed to accommodate these larger vehicles. One of the first charging corridors for electric trucks in the world is the I-5 on the North American West Coast. This corridor is showing us one of the paths forward for electric trucking. Another model may be return to base, with vehicles never straying far from a central terminal. This ensures that they will never be far from a charging station. That's already how many commercial fleets are operating. At EVS in 2019 last year, Renault told everybody there that this is the target that they have in mind. These are the trucks that they will be, electric trucks that they will be developing, those that are returning to base. And why? Because the charging solutions associated with those are much less expensive. The number of applications varies, and so do the charging solutions. We've got long-haul trucking, short-haul delivery, drayage services at ports, and the list goes on. Charin, the international grouping of manufacturers who are working on these standards, is talking about 1 to 3 megawatt chargers, people, for some commercial trucking needs. This is enormous. Most electric grids are incapable for such energy demands. So the kind of solutions that were just talked about by FreeWire may be much more interesting for commercial purposes moving forward. Already, Daimler is organizing information sessions for electric utility representatives to inform them and help them prepare for their vision of electric commercial trucking. And Daimler is talking about needs over the next 5 years. 5 years. Are electric utilities going to be ready for such demands in 5 years? I know we just heard that maybe electric utilities aren't the best players for this, but I think they have an important role to play. Who's going to pay for this infrastructure? Ahmad mentioned earlier the finances are challenging. Revenue streams, at least in the short term, are not going to justify such investments. More than ever, we need private, public, private, and I say private twice because I think that's the proportions we're going to be looking at in the future. These kinds of collaborations are going to be key. Governments can't afford to carry the cost of infrastructure deployment alone. Partnerships are going to be essential. And these partnerships are going to bring together government entities, vehicle and charger manufacturers, network providers, and electric utilities. And before I finish, I want to describe a sustainable commercial mobility solution that we at Marcon developed for Propulsion Québec, which is the electric and intelligent industrial cluster that's based in the province. We describe commercial consolidation hubs that will be located on the periphery of urban areas. These hubs will be where heavier vehicles, trains, trucks, and other types of vehicles are going to be offloading their goods at consolidation centers, and the goods will then be distributed to appropriate lighter electric vehicles for distribution within the urban area. This will result in less of a strain on infrastructure within the urban areas. These hubs are going to be charging hubs as well. So each hub needs to start being planned today with all stakeholders participating, including the investment community. And I think this is probably the way we're going to have to move forward. I don't have the solution. I just know that without collaboration, we're not going to get there.
Thank you so much, Catherine. There was so much in that. You know, I've just seen that the chat panel pop up of bunches of questions and thoughts that have just sprung from what you've had, and we're gonna get to these in a minute. But we've got some audience questions now. So if you're in the audience, please take a look at that Q&A box to send Catherine some questions, and so we can follow up on that. But we do have one straight away. The transcontinental highways and railways in the past, initially they didn't make financial sense for governments. Just had to foot the bill for the infrastructure so that they could actually ignite, you know, this transcontinental transport. Can governments do the same, or how does this happen in a public-private private-public-private partnership that you mentioned moving forward?
I don't know how it would exactly happen, but we're starting to see increasingly governments that are investing in infrastructure with the intent of eventually making money. And I'll give you an example. The Caisse de dépôt, which is here in Quebec, is in the investment arm of the government of Quebec. And we know that the government of Quebec, at least in North America, is one of the leading governments as far as electrification of transportation is concerned. One of the things that the government has done is, in collaboration with the investment arm, Caisse de dépôt, which obviously needs to make money, right? This is an investment arm of the government that takes the pension money of all Quebecers and invests it. And one of the things that it's investing in right now is the creation of an electric train here that will join Montreal with the South Shore, the West Island, every part of the city. So what we're seeing for the first time is a potential model that could work. Governments are the ones that are trying to do what's in the best interest of the public. And we need to be able to work with governments in order to not only invest in areas that may not be revenue positive or profitable for the private sector, but eventually try to invest in ways that are going to create money for taxpayers. And this is the model that the Caisse de dépôt, I think, combines. It combines the investment side with the government side. And I think we're going to be seeing a lot more of these moving forward.
Excellent, Catherine. Thank you very much. We have one very brief question to ask before we jump into the next panelist, and we're just going to do this one really quickly. How does the US and perhaps the Canadian market differ from others in terms of investment in e-mobility?
I think that the US market has probably benefited from more private investment than even the Canadian market. Mm-hmm. And I'll give you an example. A company like Nissan, which has invested in infrastructure both in Canada and the United States, has been a lot more active in doing so in the US market, and it has done so in proportions that are greater than the 10-to-1 that we see in the population size. Mm-hmm. Now, the reasons may vary. I don't know what their reasons are, but we have seen that the Canadian market could likely benefit from a whole lot more investment than the US market. And in the US, we have seen certain markets, even within the United States, that have benefited more than others. California, for example, has been at the front end of most mobility trends that we've seen over the last few years, and continues to lead even in the EV space and in the infrastructure space. I know that we talked about why make ready may not be the ideal way to move forward, but right now in California, a lot of the electric utilities are using this path for encouraging the electrification of heavier vehicles. I think we're learning. I think having spoken to some of the representatives from these utilities in the last few months, I heard that one of the things that they underestimated is the amount of money and effort that needs to go towards education of this group. And I think this is something that we haven't talked about, but we are going to need to talk about. The more educated, the more likely we are to make the more informed investment decisions. And even in this market, the market that we're trying to target, we're having a lot of awareness and education issues. And this is one of the areas that we're going to have to invest in more heavily. Are electric utilities the ones that need to be investing in this? Should we be using other partners in order to be able to do this? In the case of California, would CARB be the ideal path for delivering this education? I don't know. I'm asking the question. We're learning now in California. And I think we're going to based on this learning, we're going to develop programs in other parts of the US and across North America that are going to be much more targeted to the needs of this specific audience.
Thank you very much, Catherine. That was, again, wonderful insight. So thank you again. We're going to move on to Roby now. Roby is the finance director of Bollinger Motors, It's great to have him today. So Bollinger Motors is a Michigan-based EV startup. Prior to Bollinger, Roby has been involved in human capital management solutions and has advised participants in more than 75 investment transactions during his work with companies like Simon Group Holdings, Atlas Oil, Questa Management, Expedition Capital Partners, Livingston Partners, WY, Campbell, and others. Welcome, Roby. Thanks for being here today with us.
Thanks, James. I feel very honored to be on this panel. Certainly a lot of experience and a lot of knowledge that I've learned a lot about the EV infrastructure space just listening to my fellow panelists this afternoon.
Yeah, thanks for being here. Let me, I have a question for you here today. And again, to those out there who are watching, please hit that Q&A box, send us through some questions for Roby. You know, it seems right now through new electric vehicle OEM investments and stock prices, it's just going crazy. There's so much money that seems to be coming into this space right now. And I'm sure you've been watching this very closely. Do you see this as sustainable, and how can new OEMs take advantage of this? And really, what's the right pathway to go forward for an OEM, you know, such as Bollinger to move forward?
It's a lot to unpack in that question. Appreciate that. Starting with, is it sustainable? You know, I think as we've heard from all the other panelists, that it's going to require a lot of investment on the infrastructure side. I think equally, you know, you're going to need to continued investment from existing OEMs in both heavy truck, medium duty truck, passenger car and light truck. You know, those continued investments you're seeing from the established companies who really are scrambling in a lot of ways to play catch up after ignoring the space for a lot of years. So that you're seeing a lot of investments, a lot of partnerships, and then you know, the most you know, I think the most telling story today is the blank check or SPAC activity you've seen, particularly around the EV space. It's a fascinating space. You know, public market investors historically, in my opinion, have not been the most patient capital. So I think you know, is it going to be sustainable? There's a lot of SPAC money that's been raised this year. I think something like triple or quadruple what was raised last year. So there's a lot of money to be put to work. As Arcadia mentioned, there's a lot of private equity money that's flowing into the space in and around electrification. So will it continue? I think it has to continue. The question is, where is it going to come from? And I think, you know, the public markets can be very fickle, and they thought, you know, that you'll see money flowing into the space. What we've heard in our exposure to that, and we've taken a look at that SPAC side. We've spoken to a number of SPACs that are actively looking for investment. So we've gotten some pretty good market insight. We've also talked to some long equity investors in the space, and fundamentally, what most of them are looking at are very, very long-term bets that they're placing. The question is, can they really stick into the companies and provide that low cost of capital the public market provides for the long term? Time will tell. You know, I'm not a public market expert, but I think it'll be interesting. For us at Bollinger, you know, one of the things that we've always focused on, and we've been very fortunate with, is our capital has come from the very beginning from our founder, Robert Bollinger, who remains our founder and CEO today. We are raising capital today because the needs of an OE in this space begin to outstrip any one individual, I guess, unless your last name is Musk. And in that case, you know, I think most of these public companies, as a side note, probably should be sending Mr. Musk flowers, because he's really paved the way, given what Tesla has done, not only as a public company, but just in general, open the door for a lot of these other companies to make a path. So what we've been focused on is really the Class 3 electrification market. So as Catherine mentioned, focusing that, you know, on the heavy duty side, classes 5 through 8. We've been exclusively focused in consumer and commercial Class 3 trucks. The trucks you see behind me on the wall, those are our passenger versions. Those are our consumer versions. They are Class 3 vehicles. Our technology today that we've developed for our skateboard can scale up to a 4 or 5 truck on the commercial side. But really, that Class 3, that medium duty truck market is where we've been focused. And, you know, as I've heard some of the other panelists say, well, we view that market to be very interesting from a commercial perspective. It's, you know, a lot of the press today is around last mile delivery. You've seen major market orders from folks like Amazon with Rivian. and Arrival in the UK, and their interest with UPS. So you've seen a lot around the last mile delivery space. We have a concept in the last mile delivery space we've introduced recently. That said, our vehicle and our core technology and our skateboard in Class 3 is designed for some purpose-built end use activities that would be more unique in different fleets. So think off-highway, off-road, very complex environments where you would need the capabilities that are inherent in our trucks. And so to that end, you know, we don't get the same amount of press in those fleet markets, but they're still very important markets that we see a lot of investment being made into. And to that end, we're talking to a number of strategic partners. And I think that's the key point I want to make here, is that what we're seeing is a lot more partnering going on. So while you certainly have institutional venture capital and private equity money still investing in the space, today what we've seen in our experience has been those venture capital investors, if they didn't get involved early in the company's life cycle, and in our case we're a little more mature, we've had a significant amount of financing come for our founder. At this point, venture capital, they want to see validation from commercial partners. So you're seeing these tie-ups with the most recent one. You know, you have Nikola and GM announcing a partnership. You know, this last year, Ford and Rivian announcing partnerships. So you're seeing a lot more of this partnering in these end markets, and really I see that as a bet by OEs to really place some strategic capital bets and inherent institutional knowledge with these companies to see which way, you know, to see which way the wind really blows. I think it's still undetermined. I mean, what we've heard from the suppliers, and our suppliers are the same as these other OEs in the tier 1 automotive supply base. What we've heard from some major key suppliers in the electrification space is that their view of the market is that the consumer adoption of EVs will happen at a much slower rate than the commercial adoption. Seems to make sense based on what Catherine has mentioned and some of the trends, both governmentally and environmentally, that we're trying to meet in terms of some of the goals. And so I think that is going to encourage additional collaboration, because the amount of capital, because the amount of capacity in manufacturing that already exists today. I think what you'll increasingly see is more tie-ups between commercial strategic partnerships in the EV space, particularly where we play, versus I shouldn't say versus, but really in concert with private institutional capital.
Thanks, Roby. That's really good. Now, I do have some questions from the audience. Now, actually, before we get to them, you know, I think one of the things that we have been noticing here is that there seems to be real differences between, you know, say a public, you know, SPAC type towards a more private one like the pathway that Rivian's gone, and also towards towards say you know, other institutional investors that might come in. Do you think perhaps that there's room for a split of all three, or do you think, you know, perhaps, you know, adding OEMs into that, you know, established OEMs into that as well? Is there room for all three of them, or do you think it's better to have a focus on one point of investment than the other?
You know, it's a good question. I think that there is room for all three. I'll just, you know, kind of caveat that with the fact that the public markets are valuing these companies today, particularly in the SPACs, and I've seen the investor presentations on all these companies. They're valuing these companies based on 2024, 2025 revenue numbers. And so if you're still 5 years out, 4 years out, that you're valuing these against, I mean, that's a lot, and you can see it in public marketplaces. I mean, Tesla, which has clearly been the pioneering market leader in the EV space, they're selling hundreds of thousands of vehicles globally, with massive manufacturing capability, with massive established entrenched technology advantages over even some of the traditional OEs in the automotive space. And so to say it's going to stay, I think that the market may close to new entrants on the public side. The people who are there are going to be public. They'll face increasing pressures. You know, but I think it does take, just like it takes on the infrastructure side, it takes a myriad of investment dollars coming in from multiple places, whether it's private, whether it's institutional capital, commercial, strategic partners. I think it takes it really takes a village to raise up this industry. And I think you're going to continue to see that those investments are going to come from multiple locations. There's not going to be one clear answer that says, this is the only path to take. You have to look at multiple pathways.
Yeah, no, totally agree, Robbie. I think going forward, I think many will be looking at those multiple pathways that you mentioned. Now, before we go on, if there are any quick questions from the audience, use that Q&A box to send Robbie a question. But in the meantime, we do have a product question for Bollinger. Will the Bollinger be bidirectionally enabled for things like V2G?
We are enabling our vehicles both on the commercial as well as on the consumer side as bidirectional for V2G capability set. We have a very large pack that comes in our base vehicles. It's a 142 kilowatt hour battery pack. And so we bring a lot of power to the equation. We can actually, the way our battery packs are designed, we buy from a module level and build our own proprietary packs, proprietary pack design, cooling, et cetera, and BMS. And the way we are done is through 35 kilowatt hour strings that we can scale up to about a 210 kilowatt hour pack. So we've got a lot of capability around that. And yes, they are going to be all bidirectional. So I think that'll provide some really interesting applications for V2G.
Very cool. Thanks, Robbie. I really appreciate your time today. And we're going to move on to Michael Lingenfelter now. Michael is the Relationship Manager and Vice President with Wells Fargo Technology Banking Group, where he oversees the banking relationships with and provides credit underwriting and financial advice and services to a portfolio of companies across the country, both early and late stage, with a specialization in clean tech or climate tech. He is the team's energy efficiency sector and transportation leader, and is also a board member of the Seattle. And he is the team's energy and efficiency sector and transportation sector leader. So thank you again, Michael, for joining us. I really appreciate your time today. Welcome.
Good to be here. Thanks for having me.
Michael, for both new EV OEMs and EV infrastructure build-outs, we just heard Robbie talk just a minute ago. What are the key measures and opportunities that Wells Fargo looks out for when investing? Now, before I go on, if there's any questions in the audience, go to that Q&A box, throw them in, and we'll be sure to ask them. So, Michael, please.
Yeah, so I don't think there's one simple answer here. So I'm going to try and cover a couple different scenarios. In finance, we often say it depends. So that's a little bit of the case here. And one nice thing about going a little later, I guess, in the lineup here is that some of my colleagues have already kind of touched on some of these things. I heard Robbie, talking about SPACs a bit there, and so to kind of seize on one thing there, we think it's one of the early innings in the electrification of transportation and the overall advanced transportation, conversion and revolution. As I was beginning to say earlier, we're really excited about this, and I sit in the technology banking group, and so we look at early stage venture-backed startups all the way through to more mature, well-funded tech companies as well, and within that, I focus on transportation, and we're seeing a lot more money come into the space, and that's really important for banks like Wells Fargo to be able to help finance this. So, one of the things we look for is well-capitalized companies. I would generally say that there's, kind of two areas of finance. There's corporate finance where you're financing a company, and there's project finance where you're financing a special purpose vehicle or project company. And I think when we're talking about infrastructure, a lot of times we're talking about the latter. There's a lot of talk, such as the conversation I was having with Arcady, in the lead up to this, about asset codes. That's really interesting in this space, looking to kind of pull together a variety of infrastructure assets and to finance that. So if I take a step back for a second, and I'll try to keep this brief, Wells Fargo, we have a innovation incubator through the National Renewable Energy Laboratory where we provide grants. We're really active in the philanthropic space here, as well as throughout clean tech and tech. And so we've had a number of success stories there. I encourage you to see our class of companies we've done there, like PowerFlex, for example, was required by EDF Renewables recently, and we're really proud of them and the progress they're making there. Through to our venture capital group, Wells Fargo Strategic Capital, that's making venture investments in early to mid-stage companies We're typically a follower, so we look for a strong lead that's somebody we know and, you know, kind of a household VC name. And as I touched upon earlier, we're seeing a lot of private equity come in. I think all of our other panelists have said that, and we're really excited about that too, because, you know, in order for a Wells Fargo to come in on the lending side, you know, we need the opportunity set to be de-risked to some extent. And one great thing about innovation, you know, it's driving this forward, but it also makes things a little challenging from a lender standpoint when, you know, technologies are constantly changing and innovating and mercurial, because we also look for a collateral secondary source of repayment, and I can speak to that a little bit more in a follow-on. So a couple other arms, you know, we're really strong on the equipment finance side, as well as on the auto finance side. So we're a strategic finance partner with Tesla, for example. That's well publicized. And what our auto finance group does generally is helps make loans to consumers like you and I that are buying vehicles, and they're really active on this space, as compared to the equipment finance side, which is more about helping lease and make loans to companies that are acquiring various kinds of equipment, and we're having a lot of active dialogue and collaboration with them. So on that side, one of the things we look for is strong off-takers and strong contracts that we're able to structure debt around.
Yeah, thanks, Michael. Actually, I do have a couple questions. One is, the first is, do you tend to invest more in existing type technologies, or maybe emerging ones that are possibly not yet proven? There's probably some risk to their rollout. Do you have a direction that, you know, Wells Fargo tends to go? Is it more conservative, or do you tend to run with some risk sometimes?
Yeah, that's a great question. So I think, you know, when we're talking about investing here, as I kind of broke down, that means a number of things to us and the finance community. So, you know, on the earlier stage side, we are active on the equity investing side. We're not a traditional venture debt lender. And so we work with a lot of third-party non-bank lenders that are venture debt providers. And so that's one of the things that our group, you know, does for our clients for the earlier stage companies, is both introducing them to our venture investing groups. And it's usually when they're a little bit later stage than the innovation incubator, for example, as well as introducing them to kind of non-bank lenders. And we have a very broad network there. You know, we can be active with our clients and on the payments and treasury side earlier on, but typically earlier on, debt is more challenging. And I think that's a facet of this space as well. As companies become more mature and they have a stronger balance sheet, they become more liquid, they've garnered more investment, you know, through some of the kinds of vehicles that I've talked about before, and are getting closer to cash flow break even, you know, positive EBITDA. You know, at the end of the day, kind of traditional bank lending is cash flow lending with a strong secondary source of repayment, you know, collateral, as I mentioned before, whether that's accounts receivable, inventory or other things. So those are some of the things we look for, and it kind of really depends on where you are in that stage. So, you know, coming back to your question on investing early stage, you know, that's really more of an equity play, and, you know, we see that more as equity risk. And then as things become more mature and are more proven out in the market, you know, with strong contracts and receivables and customers, that's when debt becomes more in the question.
Totally makes sense. Do you have, just as we go on from that, do you have any advice for, let's just say, early stage companies who are at seed, post-seed, Series A type rounds? What advice would you give to them to be able to, you know, that are in this space right now? What advice would you give to them to encourage them to grow, or to encourage them to find the financing that they need?
Well, I think first and foremost, focus on your customers. Customers first, focus on your product, build that out, and everything else will follow. You know, unit economics are important as well. You know, without the unit economics, you can't get to positive gross margins, and without that, you can't get to cash flow. I think increasingly in the space we are seeing, you know, as some folks mentioned earlier, that generally in the tech space, but also we're seeing this especially play out with the SPAC market and some IPOs in the transportation space, that investors are willing to, you know, put off cash flow, you know, much further, and invest in an earlier stage with the kind of the promise of that later cash flow, But they'll still look for, those basic unit economics. And I think especially as follow-on rounds come, that becomes more and more important, and a pathway to break even is more important.
Yeah, no, thanks. That's some really good advice here. I'm sure there's a whole bunch of people watching today that are, with companies that are at early and medium stage. And I think that's some, really helpful things for them to move forward. So thank you very much, Michael. What we're going to do now is we're going to have some panelist questions. So what will happen is I'll be introducing the panelist and the person that they're asking to, and they're going to ask that question as we move forward. We do have a whole bunch of questions that the panelists have got for each other. So firstly, I would like to start. Michael, you're right here now. I know you've got a question for Ahmad around state-run infrastructure and green banks. Please shoot away for Ahmad.
Sure. Yeah, I was appreciated your comments earlier, Ahmad, and was thinking about the California Infrastructure Bank, New York Green Bank, and lots of other organizations, initiatives coming up like this. What role do you think they have to play, and how can banks and other private entities best partner with them?
Yeah, that's a great question, Michael. And I loved what Catherine said about the public-private construct for being able to fund EV infrastructure, charging infrastructure on a large scale. Because I would submit that if you take, for example, our state infrastructure bank in and of itself, or even the state grant funding that might help backstop borrowing by a municipality to fund EV charging infrastructure, that is not sufficient, in my view, to be able to do so on any type of large scale. You have municipal equipment leasing programs that for a smaller deal, $15, $20 million, you probably find a way to make that pencil. But I really think that concept, and I don't know what that broader answer is. I thought Catherine was really eloquent in laying out the framework for a solution. But I think if you can somehow tie the economic output from a commercial corridor or a charging corridor, where you have that third leg of the stool being user fees, or I don't know what it might be from that third private component and contributing to funding the infrastructure, I think that's how you get there. But you certainly have the vehicle in using the state infrastructure bank and being able to use, we call that, it's almost like a joint venture where you have the municipality issuing through that debt vehicle. It does sometimes, I think, it sometimes is a better option than the municipality issuing on its own.
Thanks very much, Ahmad. Next question we have here is, Roby has a question for Ahmad again with regards to retail fuel locations and converting to electric points. Roby, shoot away.
Yeah, sure. Thanks, James. Ahmad, as you were talking, it got me thinking when we talk about the complexity of and the number of charge points you'd need. Earlier in my career, I ran a family office here in town that was built upon the backs of the diesel and gas distribution. So the traditional fossil fuel industry, and you have truck stops and gas stations throughout the country. That would seem like the most logical spot to convert those points to electrification. I mean, the question I have is, you've seen some of these, and Arcady mentioned some of the early investors, that have gotten into the space. Why aren't we seeing more of that, particularly on the retail side, or where the large retail networks aren't investing in some of that charging infrastructure?
Yeah, I mean, that's a great question. I think there's a real opportunity there, and I'm not sure exactly what the challenges have been to date when you look at that. What comes to my mind is the lack of scale, right? If I'm thinking about how you might structure a financing around this, and you don't, you're looking at one-off projects, you don't have to scale across an entire network of stops. It doesn't really, in my view, begin to pencil. Now, where that might be different is the notion I had mentioned in my remarks around the ESG investors. When you're looking at impact investors that might have a mission that is beyond only the return that might be driving their decision. But I would imagine, I might submit that it's probably an issue of scale. I'm curious if others in the audience or others on the panel might have more thought around that. But scale seems to be an issue when we look at, if you're just talking about trying to get a municipality to do a fleet financing, right, for an EV fleet that might be their vehicles and include police vehicles as well. You often don't have enough scale to be able to drive the financing that you would need to beat a pay-as-you-go option.
Thank you, Ahmad. That's really helpful. I know Michael has a question for Arkady. Can you, Michael, ask Arkady that question, please?
Sure. Yeah, I was just wondering, Arkady, what you kind of think are some of the high-level numbers, going back to your discussion, that you think are needed, whether it's in California or United States or however you want to frame it. That demand play, I think, is really interesting. A little chicken and the egg, right, that we face in this industry as any emerging technology. So, what do you think are some of the numbers that are needed?
Yeah, I think the best source for those numbers comes from McKinsey. McKinsey put out a great kind of article last year. Charging Ahead is the title, and they estimate that by 2025. In the US, we will need about 6 million chargers across the US, and and then by 2030, we'll need about 13 million chargers across the US. That's a cumulative spend of $11 billion in the US on charging equipment alone, not including the cost of energy or some of the other kind of soft costs around that industry. If you look across the US, China, and EU, ignoring all other smaller regions, they estimate that we'll need about, 45 million chargers across the US, the EU, and China, and we'll need to spend about $50 billion cumulative by 2030 on charging infrastructure. So it's a huge amount of spend, right? It's a massive opportunity for any investor coming in the space, but I think particularly it's a big opportunity for the private equity part of the space, and then later on, once the risk, I think, decreases, I think the more traditional banks like Wells Fargo.
Thanks, Arkady. Much appreciated. Roby, I know you have a question for Catherine surrounding fuel cells and battery electric. I know a lot of us have that sort of questions in mind. Roby, please shoot away for Catherine.
Thanks, James. Catherine, in listening to your comments around heavy duty and particularly long haul trucking, I think we're seeing a lot more attention being paid to fuel cells versus a pure battery electric vehicle for long hauls, given the weight and density comparisons. I'm just curious to get your opinion and weigh in on who do you think the winner is there? Is it fuel cells or is it BEVs?
That's a really big question. We're talking about the beta VHS thing, like maybe all over again. I don't have the answer. I think that battery technology this is a question that we've been debating here in Canada for a long time, because the hydrogen industry is a big player in the Canadian space. So my opinion is, we've been at Marcon, we've been working with hydrogen technology since 2002. And we keep hearing that hydrogen, like widespread hydrogen use is only 10 years away. We've been hearing about that since 2002, like when we started in this space. I think that hydrogen applications are going to be, we're going to start to see a lot of them in the next few years. I think long haul trucking may be one of the areas where we're going to see this. But again, we haven't seen the end of the development of battery technology. Battery technology just keeps improving, and the cost just keeps coming down. So if we could figure out, and maybe the FreeWire solution may be one of the solutions that we need to start thinking about. But we certainly need to start looking at ways that we're going to charge these vehicles in an economical way. The kind of chargers that we're hearing coming out of Sharon, 1 megawatt, 3 megawatt chargers. I even heard somebody talk about 5 megawatt charger. I said, man, if I wasn't sitting down, I'd be falling off my chair. We're not there yet as far as the capabilities of our electrical grids. And so I think we're going to need to come up with better solutions, because honestly, one of the things that I was talking about with James earlier this week was, you know, hydrogen. One of the issues is the deployment of infrastructure. And when we're talking about 3 megawatt chargers, yeah, we're starting to talk about that as well again. So we need to find more economical solutions. I know that Daimler, Tesla, and some of the others have this in mind, but is it a change of the way we move goods around that has to change? Maybe we need more of those hubs, and those vehicles should not be traveling more than, I don't know, 250 or 300 kilometers. That's what Renault is talking about as far as Europe is concerned. But maybe we have a different opportunity here. You know, North America has really huge spaces. You know, we're not talking about European style traveling. This is, you know, like very, very different. So, you know, will we be looking at more corridors like the I-95? That would be the I-5, that would be really interesting as well, but we need to come up with better solutions. And that's why I think that listening to Arkadi's description of his solution might be one of the ways that we need to look moving forward, because I agree, it is going to cost a lot of money. And this is why I keep underlining, we need to think about tomorrow's technologies, not the technology that's in the vehicles today. Okay, so you know, and this is the error that I think many of us are making. You know, we keep looking at what is the technology that's out there now, and we're planning 5, 10, 15 years into the future, which isn't the right thing to do. We need to start looking at technology developers, start to evaluate, you know, what are the likely developments over the next 5 years, and start to develop charging solutions around those developments.
Thank you, Catherine. That's just really great. So what we're going to do now, we're going to finish off the panelist-to-panelist Q&A. But before we finish up our time today, I'd just like every panelist here just to give perhaps their one-sentence thought on what the direction is for electric vehicles now and future investment, and a key message that you would like to leave our audience as we move this away. So Ahmed, can you give us your closing sentence for us?
Sure, and I would take it from Catherine's remarks, which I was really struck by what she said, the private, public, private, and the need for that third leg of the financing stool to see large scale.
Thank you. No, that's really terrific. I think that's a great thing for us to remember. So next person, Arkady, what's your one sentence thought you'd like to leave everyone with?
Look to Europe. 20% of stimulus spending as part of the COVID pandemic went towards clean energy across the European Union. In the US, that was 1.1%. Europe has 8% penetration of new vehicles that are electric. The US is hovering around 1 to 2%. Look to Europe to see what's happening next. And that, by the way, answers a question about the oil and gas majors in the US that was asked earlier. You have oil and gas majors in Europe, much more forward thinking. So we need to follow that example, follow that model.
Excellent. Thank you, Arkady. I think you're right. That is absolutely key. Catherine, what's your last word or last sentences as we leave today?
Hang on tight. This is going to be a really, really quick journey, I think, over the next few years. We're going to be requiring investment, but we're also going to be requiring education. And I think this is the piece that's missing for, as far as this industry moves forward. We need to educate the decision makers better.
You're absolutely right. Thank you, Catherine. That's great. Michael, what is your takeaway for today?
Revolution's here. there's a lot of money to be made. It's one of the greatest opportunities of our lifetime. And it's really a systems approach. It's really integrated platform. So everything from the utilities to the battery providers, everything under the sun. I think fuel cells will have a role to play. And I agree, it's going to be exciting.
Absolutely. I think for me, that word too exciting, that's exactly where I'm coming from as well. Roby, what is your thoughts as a closing statement for us?
Sure, I'll end on a lighter note. I'll echo what Michael was saying earlier, that we're in the early innings, but in the near term here, I'm just all spacked out at the moment.
I like that, all spacked out. That's funny. That's good. So in closing, I just want to thank everyone today for coming. Thanks, Ahmad. Thanks, Katie. Thank you, Catherine. Michael and Roby as well. We really appreciate your time today. You've had to take a couple hours out of your work this week, and that's something on behalf of World EV Day that we 100% appreciate, because this sorts of discussions is what we need moving forward. So I want to just thank our audience as well. Thank you for tuning in. Thank you for listening today, today's speakers, both for the panel earlier and for the panel today. And on behalf of Green TV and World EV Day, thank you very much for attending today.